This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
U.S. crude oil production this year will rise by slightly less than previously expected while demand will fall, the U.S. Energy Information Administration, EIA, said on Tuesday. The EIA issued the new outlook after Saudi Arabia and Russia extended voluntary production cuts of 1.3 million barrels per day through December as demand concerns weigh. U.S. crude oil production will rise to 12.9 million barrels of oil per day in 2023, the agency said, compared with its previous estimate of 12.92 million barrels of oil per day. Oil prices struggled on Wednesday after sliding to their lowest levels in over 3 months in the previous session, weighed down by concerns over waning demand in the world's top oil consumers, the United States and China. Brent crude futures advanced by 15 cents to $81.76 a barrel by 0636 GMT, while U.S. crude futures dipped 2 cents to $77.35 a barrel. Both declined to the lowest since July 24 on Tuesday. The market is clearly less concerned about the potential for Middle Eastern supply disruptions and is instead focused on an easing in the balance, said Warren Patterson and Eva Manthe, analysts from Bank, in a note to clients, referring to an easing in tight oil supply conditions.
Moving on to the top news in the energy sector.
Global fossil fuel production in 2030 is set to be more than double the levels that are deemed consistent with meeting climate goals set under the 2015 Paris Climate Agreement, the United Nations and researchers said on Wednesday. The United Nations Environment Programme's UNEP report, assessing the gap in fossil fuel production cuts and what's needed to meet climate goals, comes ahead of the global COP28 climate meeting which starts on November 30 in the oil-rich United Arab Emirates, UAE. Fossil fuel phase-out is one of the pivotal issues that will be negotiated at COP28, Ploya Chakalvisit, Stockholm Environment Institute, scientist and a lead author of the report said in a press briefing. Export prices for Russia's ESPO blend crude have slipped to a discount to benchmark Brent in Chinese ports as demand from top buyer China eases and freight costs have jumped after the U.S. sanctioned 2 shipowners, 3 market sources told Reuters. Lower prices for the crude grade that accounts for the bulk of China's oil purchases from Russia and higher shipping costs are squeezing profits for Russian producers that are delivering oil to its customers despite Western sanctions aimed at curbing Moscow's ability to finance the conflict in Ukraine. ESPO blend loading from the far eastern port of Kozmino in December is trading at discounts of 50 cents to $1 per barrel to ICE Brent on a delivered ex-ship day basis at Chinese ports, the sources said. Next, we have the top news in metal markets. The weakening of a long-established correlation between the price of exchange-traded funds, ETFs, tied to gold and gold mining stocks have investors eyeing a range of potential causes, including massive buying from global central banks and shortfalls in gold production. The SPDR Gold Shares ETF, which tracks the price of gold, has rallied 9.82% this year, driven by concerns about inflation and economic growth as well as geopolitical turbulence. Yet those gains have not been reflected in the share prices of gold miners. The iShares MSCI Global Gold Miners ETF and the VanEck Gold Miners ETF, which track the shares of gold producers, are up only 2.28% and 1.7% respectively. Copper traded within a tight range on Wednesday as a stronger U.S. dollar offset supply disruptions and investors awaited more clues on the Federal Reserve's future policy path. 3-month copper on the London Metal Exchange was little changed at $8,188 per metric ton by 0715 GMT, while the most traded December copper contract on the Shanghai Futures Exchange slid 0.2% to 67,500 yuan, $9,274.53 per ton. The dollar regained its footing on Wednesday and inched higher after a slew of Fed speakers left the door open to further rate hikes, while traders shifted their focus to a speech from Chair Jerome Powell later in the day on the central bank's future policy path. We will now look at the top news in the agricultural sector. China booked its largest single-day U.S. soybean purchases in at least 3 months on Tuesday, traders said, offering a glimmer of hope for the most valuable U.S. farm export after overseas sales of the 2023 harvest had fallen well behind the normal pace. Chinese importers bought around 10 cargoes of soybeans, or about 600,000 metric tons, for shipment from Gulf Coast and Pacific Northwest export terminals between December and March, trade sources said. The sales would be a relief to U.S. farmers, who have seen Brazil dominate the global export market for soy as well as corn for longer than normal this year.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.